What is diversification? Diversification is the practice of spreading your money across different types of investments to reduce risk. Instead of putting all your money in one place, you invest in a mix, such as shares, bonds, property, or companies, based in different parts of the world, like the US, Europe, or Asia. That way, if one part doesn't do so well, the others can help balance things out. Why diversification is important? Because no one can predict the future. Not you, not your mate who loves crypto a little too much, and not even professional investors. Markets go up and down, and sometimes things go wrong. A company might struggle, or a whole industry might slow down. If all your money is in one place, you feel every bump, but if it's spread out, you're better protected. Some things might dip, but others could hold steady or even grow. It helps smooth out the ups and downs, and makes the whole ride feel a bit calmer. Here's a simple example. Let's say you put all your savings into one company. If it does well, great, your money grows. But if something goes wrong, maybe it loses money, or there's a scandal, your investment could take a big hit. A real example of this is what happened with Enron in the early 2000s. It was a huge energy company in the US that looked very successful until an accounting scandal was uncovered. The company collapsed almost overnight, and investors who had put all their money into Enron lost everything. It's a reminder that even big popular companies can fail, and why spreading your money around matters. Now, let's say you split that same money across lots of companies. Some in retail, some in tech, maybe some in healthcare. A few based in the UK, and some overseas. You might even include other things like government bonds or property funds. These all behave differently, and they don't all go up or down at the same time. So when one part struggles, another might be doing fine, or even growing. That's what diversification does. It helps keep your overall plan on track. What else should you know? Diversification isn't just about picking a few random investments, it's about having a mix across different types of assets, sectors, and countries. You can also think about risk and reward. Some things, like shares, might have higher potential returns, but more ups and downs. Others, like bonds, are usually more stable. The mix you choose depends on what you're comfortable with and how long you're investing for. If you're just starting out, you don't need to figure it all out yourself. Many people use funds. These are ready-made bundles that spread your money across lots of investments in one go. It's a simple way to get diversification without needing to be an expert. Even with diversification, there's still something called market risk. That's the risk that the entire market drops, like during a financial crisis or recession. Diversification can't eliminate this kind of risk completely, but it can help soften the blow. In fact, research has shown that owning around 20 to 30 different stocks is usually enough to reduce what's called unsystematic risk, the risk tied to individual companies. Beyond that point, each new stock adds a little less extra protection. So having a good mix doesn't mean owning hundreds of things, just enough of the right kinds. To sum up, diversification won't remove all the risk. Nothing can do that. But it does stop your whole plan depending on just one thing going right. It's a bit like the old saying, don't put all your eggs in one basket. If that basket drops, you could lose everything. But if your eggs are spread across a few different baskets, one mishap won't ruin the whole lot. It's a way to invest more confidently, with fewer surprises, and that makes it easier to stay on track for the long run. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.